Right. Hello, everyone. Happy Wednesday. Welcome to the Multifamily Freedom Chasers Financing Zoom. My name is Shelly Miles. I am a commercial mortgage broker and the co-founder of Adventure Commercial Capital, together with Mr. Jerry Miles over there. Do you want to take over?
I will. Share screen now. Okay. All right. Can everybody see my screen? All right, cool. So I am Jerry Miles. That was my wife. Oh, this is all right. So just a second to figure out the screen here. All right. So today's agenda. We'll go a little bit through the community ecosystem. We'll hit some introductions of ourselves, and we'll ask a few of y'all to introduce yourself. And I've got a few that I've already talked to that are gonna talk for a minute here today. Then we'll go into the current debt market update, and then our main topic today is how do lenders underwrite deals? And then we'll do a question and answer at the end. So the Freedom Chasers community. These three guys over here on the left set this up. I guess it's been almost a year now that they've been doing this. And Trevor, Marcel, and Victor, they put this together and set this community up for like-minded individuals to be able to communicate, talk, and educate themselves and each other on multifamily investing. And so Sundays, they host a call on, we call that the activation call. And usually have a celebrity guest on there. Mondays, we got broker talks with Peter and Ed. Tuesdays, napkin underwriting with Will, Aldo, and Ed. And then alternating Wednesdays, you have us doing the financing Zoom. And then on the off Wednesdays that we're not on, you have Avishkar and Andrea doing a Zoom about team building. So the information that you guys, I can't stress it enough, the information you guys get on here is better information than I've seen given out in some paid programs. So, and this is all free. So I've actually been a part of a mastermind that we paid $40,000 for to be a part of. And I believe that the information that you would get here on this one, on these Zooms here and with this group is probably superior to what we paid $40,000 for with another group. So don't take it lightly. It's here, and it's a great program, great information. So who are the Miles? Did I miss a slide? No. Okay. Who are the Miles? I'm Jerry, and it's my wife Shelly, and we also have JJ on here. We are commercial mortgage brokers and the co-founders of Adventure Commercial Capital. We lend on commercial real estate nationwide. Not just multifamily, we'll lend on all different asset types. And, through Freddie and Fannie on multifamily is our best options there. But we have a development program that we're really excited about that is a development line of credit and starts at $20 million. And there's no cap on the amount of money to lend on with this product. And it's probably the best product on the market for development deals. So if you know somebody that's doing development or you have one that you're working on, reach out to us. We'd like to share more about it with you.
I do apologize. You did miss a slide. It was my fault. Yeah.
Okay.
It's on the next one.
Next one. This one?
After that. After hours. After the last one you were on. Yeah.
This one? Okay. All right. So the Multifamily Freedom Chasers community journey. And I guess at this time, Trevor, if you want to come up, and I'll just let you do this whole thing here. And if you like, you can do this part, and then you can go ahead and and tell us the other stuff that the Freedom Chasers have going on.
Cool, man. Cool. Thank you so much. What's going on, everybody? It's good to be here with you all outside of a Sunday evening. And Jerry, Shelly, JJ, y'all are pillars in the community. And man, who knows where we would be without y'all. So thank you so much. But back to the slide. We think it's important, and I say we. That's the four Freedom Boys and the community leaders think it's extremely important for all of our community members to have clarity on what their journey may look like moving forward after you take advantage and get plugged into everything that's out there for free in the Multifamily Freedom Chasers community. So your journey can unfold in one or two of these ways. Honestly, you see three paths outlined here, but the first one is, hey, no thanks, multifamily isn't for me. I'm going to go chase my freedom using another vehicle. No problem. Chasing freedom at the end of the day is what we're all about, whatever that looks like for you. Number two, second path, right in the middle of the screen there is, you love multifamily real estate, but for your specific season in life, whether you're just super busy or don't have the bandwidth to really do what it takes to execute successfully as an active multifamily real estate operator, you just want to be like, hey, I'll let somebody else do the dirty work, do the hard work, and I'll just be a hands-off investor in those deals. So your journey could unfold like that. And at least now you're more sophisticated and educated to vet deals that would be presented to you. And then journey number three is where you love multifamily real estate, absolutely. And then you want to go all in on learning how to be a successful, active investor. And after tapping into all the free resources for the Freedom Chasers community, you want to continue on your journey, and you have an opportunity to utilize our Preferred Partners program. And that program, I know there's a slide coming up here. Is it the next one? Jerry, Shelly? Yeah, let's just go ahead and go there.
Okay.
Just to get the visual. And it's me talking about it on the video, but you guys got me here live tonight, so no need to press play. But the Preferred Partners program, if you want to continue leveling up, it's pretty cool. It's basically the groups that we as the Freedom Boys have invested in ourselves to continue our education and action taking. Pretty cool. The Preferred Partners actually have about $2 billion of assets under management, which is amazing. And there's not that many preferred partners, so they're operating at a high level. But anything and everything you would really need to understand multifamily at a really high level and sophisticated level. There's great resources on there for education, and also great resources on there for building your multifamily business. So check that out at freedomchaserscapital.com under resources and preferred partners. And obviously I'm happy to chat with you more about it if you want to jump on a call. So that's it for those two things there, Jerry.
All right.
Awesome. Thank you, Trevor. If you want to put your info in chat so anybody can reach you, that would be great.
All right. So I will. All right. And Trevor, did you have anything else that was that it?
Jerry, I can say a little something else, based off our conversation earlier. So everybody, Jerry was super nice. He reached out to me. He was like, Trev, you guys, y'all do so much for the community. Everything is free. And I know that y'all have more going on than just the community stuff. You have your business stuff going on at Freedom Chasers Capital. These two run parallel to one another, MFC and FCC. And of course, they funnel into the vision that we all share collectively, chasing our freedom to have more time to spend on what brings us meaning, purpose, and joy. Jerry was like, Trevor, you just got to just let people know what you got going on, what you're trying to do right now, and come on our Zoom and we'll give you 1 minute to talk about it. So I myself personally am currently looking to connect with people that are potentially interested in being equity partners, passive investors for any deals that we would have coming up with Freedom Chasers Capital. And so what I'm going to do is that if that's something that's on your radar and you're here in this Zoom and you want to be on our radar as a potential hands-off passive equity partner on a deal that we got coming up in the future, I would ask you all, go to that link that I just dropped in the chat, fill out the form and let's jump on a call and just see if we're fit. Yeah, would love to have some engagement with you, have a conversation, and just kind of see what happens from there. So, Jerry, with that, I will stop. And everyone, good to be here tonight, and let's keep chasing our freedom together.
All right. Thanks, Trevor.
Yes, sir.
Yeah. And I had another person I talked to, Sean. If you were wanting to share a little bit, feel free, and then I'll open it up to anybody else.
Hi. My name is Sean Thompson. I'm out in Knoxville, Tennessee. I'm helping people who have got deals. I'm helping them get sponsorship so I can help you sponsor your deal. I'll work with Jerry to see if we can help get you financed through the bank so I can help you with your sponsorship. And then also, if you have any deals that you would like some advice on, that you already done some underwriting on and did some research into, I'd be happy to help you with it.
Awesome. Thanks, Sean.
Yes, sir. Thank you. Thank you for giving me the opportunity to speak.
Yeah, for sure. And I got time for one more. If anybody else wants to just tell us who you are and introduce yourself.
Hey, Jerry, this is the Hawk, man. How you doing?
Hey, what's up?
Hey, man, it's Mike Hawkins. I want to thank, I met a new investor, Loca Brooks. I invited her on like just before the call started. She's really interested in getting a multifamily. She's an investor with a lot of, single family properties, a few multi-units, but I told her I would give her like an introduction to the community, and we just want to make sure that she, keep this up and is welcome in the community. So everyone knows me here. So I love the Multifamily Freedom Chasers community. Trevor's my guy. JJ, Shelly, Jerry. I see the Miss Grits in here. Freddie and Sean, my brothers. But just happy to be here and just can't wait to get started.
All right. Thanks, man. Appreciate it. And welcome. Loca, is it Loca or Loca?
Loca, thank you. Just
Loca,
happy
okay.
to be here. Thank you, Mr. Hawkins, for the invite. Truly excited just to tap in on a higher level. As he mentioned, I have a few multifamilies in the Midwest, but I'm definitely looking to expand my portfolio and just tap in with some awesome people that's doing the business. So happy to be here.
Awesome. Good to have you. All right. And Shelly, was you saying something?
We got time for one more if you like.
Yeah. Okay. One more.
Anybody else? Use themselves. Now is the time.
Hey guys, it's Freddie. Some of you know me, some of you don't. I'm pretty bashful. Hardly ever speak on these things. No, not really.
They're laughing.
Anyways, glad to be here. I love it when I see JJ on these calls here and on Legends. It just makes my heart smile. Get them young, teach them right. It doesn't only go for spouses. So got to teach these kids how to do it the right way.
That's
Anyways,
right.
Thanks for inviting me. Glad to be here.
Awesome.
Even though you let Sean on here, but it's all right.
Thanks for being here, Freddie. All right.
Hello. Hey, Shelly and Jerry, hope all is well. This is Ben Johnson. I'm out of Atlanta, Georgia. I've been on a few of your calls with you guys in the Freedom Chasers. Actually in New York right now. Next to me is Carlos Salmoron. He works with me at the circus. Some of you may know I actually work with a real live circus, and we're based in Atlanta but travel around the country. And I was explaining to Carlos the multifamily journey that I'm on, and he's very much interested. So since we were together today, I said, hey, let's check out this call so you can get a little bit more information on what's happening. So just want to introduce Carlos and say hello to everybody.
Hey, great.
Nice to meet everybody.
Hey, good to meet you. Thanks for being here, guys.
Thank you.
All right. So we'll go ahead and move on right here. This is our contact info. If anybody would like that, any questions you'd have on anything real estate related, or just anything. Call us about anything. That's my cell phone number, and that's both of our email addresses. And then I believe if you take a picture of the link right there, what's that? Is that to our website, or what is that? To our website?
That's-
Okay. Okay, cool. So take a screenshot if you don't have it, or picture with your phone or whatever. So.
And I just want to add one more thing. Don't forget to share your information. This is not just an educational Zoom. It is also a Zoom to connect with each other and collaborate.
Yep, for sure. And I'm going to look for something here on my phone. I should have been more prepared than I am, but. Okay. All right. So the current debt market update, where the current rates, the Fed rate, we're still at that 5.25 to 5.5. The highest federal funds rate in 22 years is what we're at right now. SOFR, a lot of our bridge debt and things is based on the SOFR rate, or the secured overnight financing rate. And that's the rate that the banks trade money back and forth. And when we get quotes now, we're turning quotes in for bridge debt and things. They're going to base it on SOFR, and they're going to base it on SOFR, and you'll get a rate like 3.5 over SOFR, or depending on the deal, 5.5 over SOFR, and they won't lock in that rate. And usually in this market, it's going to change on a monthly basis if you have short-term debt on a property. We look at the 10-year treasury, and that's what we base a lot of our longer-term debt on. So the 10-year treasury, 4.11, that puts your rates, if you're you're getting a multifamily quote right now on on a larger asset, you might be down in the low sixes, anywhere from the low sixes to the high sixes right now. So probably about the best rate you could get if we had some affordable housing and things like that. You could probably get down in the fives, the 5.8 range. But most everything's going to be in the sixes if it qualifies for agency debt. If you don't qualify for agency debt, the banks are kind of all over, but then private debt is anywhere from 7 to 9% right now. So in the market, everybody knows that there's some issues going on because of the way the interest rates going up and things. The thing to realize is that the shock to the market, I guess you'd say the hurricane, has already come through with the rates jumping the way they did. And what we're feeling now, and what we're going to feel over probably the next year or so, is just kind of the cleanup of that problem that we had, or I guess you could say it's an earthquake, and then everything else is the aftershocks or whatever. And what are my lenders saying and doing? We have some that are getting more aggressive and looking to fund more deals. And we have others that are backing up and cutting different programs out of their, cutting different programs out of what they're offering. So it's kind of a mixed bag there. But I will say that all of them are being more cautious when it comes to the leverage that they're giving. The DSCR, instead of, where we used to be able to get a 1.2, we might be a 1.25 or a 1.3. So just getting a little more conservative with the way they underwrite things. The good in the market right now is that the lenders are still looking at deals. They're still answering phone calls. They're still trying to get deals done. So that's a good thing. We could get to a point, if things get real bad, to where lenders just start dropping out. I don't really foresee that happening in this cycle, but that's happened in the past, so right now I think we're in good shape as far as, the overall. I mean, there's some short-term pain going to be happening to some people. We've had interest rates hiking, and then people that are in, adjustable debt, because of inflation and the storms and things, and insurance rates have gone up, which aren't helping the issue. And then we've had taxes going up as well because we've had the property values going up so fast. And all those things together are putting some apartment owners in a pinch. And the ones that can hold on are holding on, and the ones that can't are going to be you're going to be able to buy their properties. So and something else I've noticed just here over the last couple of weeks is that borrowers are getting less rate sensitive. People are, instead of hoping to get that best rate, they're right now just saying, hey, the rate really don't matter. As long as the property cash flows, if I can make my property cash flow and I can get my investors a good rate of return, it doesn't matter what the interest rates are. And I think there's a lot of people starting to get to that point as well. So it's just part of the cycle of, and a lot of it's a mental cycle with the sellers, getting them to realize that, hey, your property, you can't sell it at a 5 cap anymore. Maybe now it's a 7 or 8 cap, or it's not a 3 cap anymore. It's now a 6 cap. So a lot of it's psychological, and it's just going to take time for everything to come around and get around. So right here, Freddie Mac, Fannie Mae, small balance loans. So they have their conventional programs, and they also have their small balance programs. Their conventional programs, Freddie Mac starts at $7.5 million and up for their conventional. Fannie Mae, $6 million and up. But these are the rates for the small balance. You can see the different terms and the loan to value, the DSCRs, all the different different ones. We got kind of a rate spread on what you can expect there on each one. So what I've found here lately is your kind of your best rates are in the 10-year, and the 10-year hybrid. A lot of the time we're going to be at a full 10 years interest only on those loans. So the main topic is how do lenders underwrite deals? And so we'll talk a little bit about the process they take, and then we'll talk a little bit about who are these guys that are doing the underwriting and what's their purpose and what are they looking for. So getting right into it, how do lenders underwrite deals? Who are these underwriters and what do they do? You always hear, you're dealing with me or somebody like me, a mortgage broker or a bank representative when you're doing these, when you're getting quotes and things like that. And then we come back to you and say, hey, the underwriter said this or the underwriter said that. So the underwriters, they're there to protect the bank, to make sure that all the criteria that the bank has for their loans and what they want to lend on is what is being lent on. They're going to make sure of all the legalities of the properties to the borrowers and just, all the paperwork straight. There's not liens on the properties. They're going to be doing all these things. Where some banks might want to lend on this type of asset with this population, with these types of jobs, the next bank is going to want to lend on maybe something a little different than that bank. And so the underwriter at whatever bank or lending institution is going to know those criteria, and they're going to make sure that the mortgage brokers and borrowers are getting it all done to the way they want it done. So so their job is just to make sure everything is accurate and correct. So they're there to protect the lender, but as they're protecting the lender, these underwriters are looking at more deals. They're looking at, in the banks and the lenders, they're looking at more deals than the average investor is. Where they might have several hundred different loans on their books. Your average investor's got, anywhere from 1 to 20 properties, right? And, that bank knows what works and knows what doesn't work. And so, when they're protecting the lender, they're also protecting the borrower from allowing you to get into a property maybe that isn't going to do what you'd hope it did. So, and a lot of times, getting turned down and, underwriting, not liking something or whatever, sometimes can be a blessing in disguise, because you don't want to get into a situation that, that's going to hurt you or hurt your investors or whatever. So, and I will say, make sure when you go, whether it's to us or to another lender, there's a lot of lenders, a lot of lending brokers out there, that, I was on the phone with somebody right before we jumped on this call, and they were struggling because they had talked to a lender, and the lender was wanting, they're trying to get a loan for $2 million, and the lender wants, I don't know, 1% of whatever the loan amount was. And, I'm like, asking questions, and they weren't comfortable with the lender because they really hadn't even done any underwriting on the deal. This lender hadn't, and they're already wanting to order appraisal and get him to pay his due diligence fee and all these things. And, I said, well, if they haven't, really looked at the deal, they haven't looked at financials, nothing like that, I don't know why they'd be collecting a fee. They should be looking at the property first, getting a quote together for you, those types of things, so there's a lot of people out here that are just there to collect a fee. When we collect fees, they're always refundable. Our fees are always for appraisals, for inspections, and all the whole 9 yards of what you need as we're coming up to a deal. And we're not going to be collecting that until we get you under contract to get you started on the process getting a loan. And those are refundable. So if you don't close for some reason, whatever wasn't spent on the due diligence is going to come back to you. So just be careful. There's a lot of crooks out there, and the lenders know that as well. There's a lot of crooks on the borrowing side, and they're going to be double checking and triple checking everything that you send to them. So I have people calling me all the time and telling me about all their experience, telling me, give me big stories. And then when it comes time to verify those things, we can't get them verified. And now they've wasted a lot of their time. They've wasted our time as well, but they've wasted their own time by trying to sneak something past that isn't going to fly. These banks and the lenders are savvy, and they're not going to fall for the tricks. So just make sure that, when you're coming to a lender, you're not trying to hide nothing, a bankruptcy, just anything like that. We need to know everything. I mean, we can get past bankruptcies, we can get past all these things, but if we're coming up to closing or we're halfway through the process and then we find out that there's something there, I mean, that kills the deal, because, at this point it's, we're too far in, and, we now know that we're dealing with somebody that's not honest. So, so just want to tell everybody that, be careful dealing with people that, aren't going to be honest with you, but then make sure that you're being honest with the lenders, because you're not just wasting the lender's time, but you're wasting your own time as well. So, so how do lenders underwrite deals? When we're looking at T12s, we're looking at P&Ls, the expenses that we're going to underwrite to aren't the same as what's on the profit and loss statement. When we're looking at a deal to find funding for, there are numbers on that P&L that are going to change. We're going to call, and we're going to make sure that the taxes, that we have the right tax rates. We're going to check and see when the property was last assessed. You might be buying it for $12 million, and the last person's paying taxes on a $5 million valuation. Well, you're not going to pay the same taxes. Your taxes are going to be almost 2.5 to 3 times what they're paying, because the value is going to be reevaluated with the new purchase. So we're going to make sure the taxes are in line. Insurance, when you're underwriting, and the underwriters they're going to add 3% to the insurance rates unless you're in Florida or Texas, and then they're going to be calling to check on the rates and tell you to get a quote. And then utilities, we're going to plan on them going up 3% every year as well with the underwriting. So, and then as we're looking at the deal and looking at the statements, anything else that doesn't seem right, the lender's going to do appraisals on those items. So if you're only paying 3% or 2% or something like that on property management, and it's a smaller property, the lender's going to be questioning that, and they're going to be verifying that through calling the property management company and tax records and just all the different avenues they have to investigate. So as you're underwriting deals, know that the insurance is going to change, utilities are going to go up, and we're underwrite to that as we start looking at your deal. Now, other things as you're underwriting, if you have a pro forma, sometimes if you have a good property manager, that property manager can look at the deal and say, hey, we're going to be able to cut these expenses. These expenses aren't going to be there anymore. Well, we're going to be able to add to your NOI at that point. The lender's going to, if you have a good property manager, the lender will underwrite to those things that they say, so. Different factors that the underwriters will look at to decide if they're going to lend on any given deal, or rates and terms and all that. Number one is location. And I say this, I think, every week. Location is key to, when lenders are looking at what deals they want to lend on, that's the first thing they say is, hey, we want to lend on deals in this type of location. And it might be they have a population that they're looking to get into. That market might need to have a certain population, or it might need to have plus or minus a certain crime rate, or if you're buying apartments, they might want the apartments to be this percentage of what the house is around itself for. They're going to have all kinds of different things they're going to look at, and every lender has their own criteria. They're going to look at the property itself. They're going to look at the condition. They're going to look at profit and loss statements, T12s. They're going to look at the tenant base, and a lot of times they'll even do an audit on the tenant base, and they're going to try to find out who are these tenants. The tenants are the ones going to be paying the bank back or the lender back, right? So they're going to be looking to see, where do the tenants work? What kind of employment is there in the area? If you're around a location that has a really huge employer, the banks don't look favorably if you have a big percentage of your tenant base that work for one employer. It puts too many eggs in one basket, too much relying on that one company to pay the mortgage. And the idea behind multifamily is to spread out how many different avenues you're getting income from. So, and then they're going to look at the borrowers. When they're looking at the borrowers, they're going to look at their history. They're going to look at criminal records. They're going to look at and make sure that, like I said before, they're going to look for bankruptcies or defaults in any way. They're going to look at all these things. So if we're applying for private lenders, all have their own criteria. Each bank will have their own. But in general, when we're looking at Freddie and Fannie debt, they're going to be looking at your personal credit, 660 or better. They're going to look at your personal financial statement. They're going to want to see that you have a net worth equal to or greater than the loan amount. And they're also going to want to see your experience with managing deals that are similar to this. And that's when Sean spoke before, Sean Thompson, when he was on here. He's got a lot of experience, got a lot of properties, got a fairly high net worth. And because of that, he can sign on your debt with you. So if you have a good deal, you're needing help getting the debt because you don't have the net worth or whatever, he can sign on with you, and the bank will okay him to buy properties up to a certain amount of money. So, and that's where the KPs are important and where they come in at. So, So question and answer. Anybody has any questions? That was just a quick rundown.
Hey, Jerry, are those are all still non-recourse loans, right?
As far as the Freddie and Fannie,
Yeah.
yeah, those are non-recourse with the, your normal, they call them the bad boy carve-outs. With, unless there's like some fraud or something found out, they won't come after you personally.
This is your financial oscopy, is what you're talking about.
Yep, that's it.
Gotcha. And is it, you were talking about employers, what are they looking at? No more than 10%, 20% max?
With military, it's all based on the employer himself. But military, I know it's 40%. They'd like to see less than 40% of a one military base. Unless it's a situation where there's a lot of different units on a military base. If you're like in the DC area where there's a bunch of different military bases around and things, and you're kind of spread out, and those military bases more than likely are going to be there for a long time. It's not like one of these out west where the only tenant base is military, and if they decide to get rid of that unit or move that unit, that apartment complex now has no tenants. And so they try to protect against that. But a lot of those things, they're going to go to like a personal audit of whoever the company is. Generally, yeah, 10, 20, 30%, depending on the company, but you can always ask for exceptions, depending on the business or whatever.
Yeah, a good example would be Clarksville, Tennessee.
And that's military town?
Yeah, a lot of military. They went on deployment. All of a sudden, vacancy rent went way up. Rents came down, and they've got 1,000 brand new units going in.
Oh wow! Okay.
It'll catch up. I mean, they'll absorb it all, but it's going to take them a little while.
Yeah, and just hopefully, the bank just wants to keep from having those times in the middle there where they're trying to catch up. They don't want to have people defaulting. So.
Yeah, I think Jeff's right. They'll never get rid of the Pentagon. I wish they'd get rid of the White House, but. I see the chat's open. Are you there, Shelly? Are you watching the chat?
I am watching the chat. I don't think there's any questions in here.
Okay.
But if you have a question, please feel free to unmute and speak up or raise your hand or put it in the chat and I can ask it for you. But now is your time, guys. Come on. Somebody said insurance in Miami, Florida is insane. I just paid $81K for a wind coverage in an 18 unit multifamily, and it's only going to get worse from here. There's a storm coming, so
yeah, 4,000 a unit or so, I guess. Wow. Yeah. Yeah.
It is killing the.
I've heard different ones talk about going from 700 per unit, and now they're paying over 2,000 a unit. And it's only going to get worse. I mean, inflation, the cost of getting construction projects has gone way up. Getting them completed has gone way up. Labor's going up, materials are going up, and then
That's nuts, though. 81,000. You can fix a lot of wind damage on a 18 unit for $81,000.
Yeah, you can. Yep.
So somebody.
Go ahead.
Somebody wants you to go back to the lender slide again.
Okay. So, so which one is it?
Did you guys see the question from Alicia? The 5 to 50 unit?
Okay, is the 5 to 50 unit lending with Fannie still a thing? or did that end in February?
No, I just took it off the slides because I've been talking about it every week. No, they're still looking to lend. Freddie and Fannie both came out in February and said that they want to lean in on deals that are 5 to 50 units. And they're looking to do that to help small operators. And they just saw that there was a need for that in the market. So they both set aside, I think, $2.5 billion apiece for the small balance, 5 to 50 units, and they're aggressively going after those deals. So if you have one, we'd love to look at it and get a quote together for you on it. And so at the beginning of February, Freddie Mac came out and said that they weren't going to raise their rates for the whole month of February too. But through February, they raised rates 3 times. So it's a weird market that we're in. But so yeah, I will say that we are going to be doing, for anybody that doesn't know, we have started a referral program, and we'll be doing one of those Zooms every month, I believe, right? Once a month, we'll be doing a referral program Zoom. And have we scheduled one for the September or no?
I have not, no.
No, okay. So we'll be scheduling one for September, sometime in September. And we'll be talking about our referral program. But we want to pay money to people when they help us get deals funded or bring deals to us. So this needs to be deals that you're not involved with personally, but we can get you some money and money talks.
And I got a couple more questions. What is the 1 to 3 year outlook for interest rates? From Jeff.
Yeah, that depends on who you ask. I watch different gurus on Bloomberg and CNBC. We sit in on Grant Cardone's real estate club calls, every Wednesday, and everybody's got their own ideas about it. I will say that none of them really know. I think we're probably going to hang out where we're at right now for a while. We might have, they might start bumping them down towards the end of the year next year. If we start seeing unemployment come down, we start into more of a recession. There's a lot of factors that are kind of up in the air right now. I mean, right now they're talking about shutting different places down because of COVID again. Who knows what's going to happen with the economy if that happens? I mean, are they going to start passing out checks to people again for staying home? Or are they going to, stop people from evicting people again? I mean, so many things to talk about when we talk about what's going to happen in the next 3 years. But, the main thing I know is when you're buying assets, people that I have talked to that have Class A assets, and then they also have Class C assets. They said that during COVID, when people were able to stop paying their rent, the Class C assets, they were plus 10% of the people that would stop paying rent. And in their Class A assets, that'd be 1 or 2% of the people that would quit paying rent. So the nicer assets, I don't want to say it like, the higher quality of your tenant base, the better off you are as the economy kind of goes down. I guess maybe just either people's jobs are more stable and they have more stabler finances, or maybe it's just some of it might be that, and some of it just might be different types of people. I don't know, but nicer assets are going to protect you against those types of things. If you buy a deal right now and you get 10-year debt, if you get 5-year debt, I think that whatever you do right now, I think 5 or 10 years from now, you're going to be in good shape. So if you buy a property today and you get a 10-year note on that thing, 10-year fixed rate, let's say next year the rates come down half of what they are now, your property is going to jump in value like crazy. And especially 10 years from now, you're going to be in good shape. If you're looking at a 10-year debt today, 10 years from now, let's say the interest rates double from where they're at now. 10 years from now, you're probably still going to be okay because your rents are going to be higher, and you're still, when you have to refinance, you're going to be in good shape then. So it's, Grant Cardone says, don't wait to buy real estate and wait, because over the long term, real estate's always gone up. We'll have a 1 or 2 year spell where real estate goes down and things are a mess, but then it bounces right back up. So that's the main thing I had to say about that is if you buy something right now and it's cash flowing and you get long-term debt on it and you manage it properly, it's going to continue to cash flow. So
Here's another question in the chat. Is there a minimal loan amount on that 5 to 50 unit?
yes, the minimum loan amount's $1 million. So with agency debt, it can't go under $1 million. They really don't like looking at them under 2 million, but they will go down to $1 million.
And that's the loan amount.
So what question on that 2 million number?
Yeah.
What percentage of the cost are they financing these days?
Oh, like if your purchase price is 2 million?
No, let's say the loan is 2. So would 2 million be 60%, 70%, 80% of the loan value? I'm on a phone, so it's hard for me to read your chart.
No, you're good.
Mm-hmm.
It can be 80%. It can be 65. It can be 75,
Gotcha.
up to 80. Okay. So up to 80, but it's all DSCR dependent. So,
understood.
Yeah. So if you get your debt service is a 1.3 and you can borrow 80% and still have a 1.3 DSCR, then you're golden.
Okay. Thank you.
Yep. No problem.
Oh, I have one other question, not necessarily a lending question.
Yeah.
And I asked the guys last week on the underwriting call, do you guys have any underwriting tools to do a 100% lease up versus something that's stabilized or even like 50, 60% lease up? Because the tools I'm using, they're a little wacky if there's like 0% occupancy and you're trying to lease it up.
Yeah. So is it new construction or is it one that you're redoing? You're doing a lot
No, this would be a complete rehab job for existing property.
Yeah, I don't have anything. Have you done projects like that in the past?
No, I'm one of the guys that I recently met. He's interested in the Metro Atlanta area and he wants to do those.
Okay.
And I let him know that being in the Sunrock program, we're always looking for things that are stabilized and properties that are stabilized. And so I was just going to see if someone had a tool that would help with that.
Yeah, and I don't have a tool, but I will say that those deals like that are getting really, really hard to find funding for.
Okay.
For multiple reasons. Somebody asked the question, where do we think rates are going to be 1 to 3 years from now? Well,
yeah, I heard you. It's kind of all over the place with things.
Yeah, if a lender lends on that deal, and let's say they give you 70% of the project, and they fund that, next year, let's say that we have a we start in a war with Russia or China, or something crazy happens.
Right.
This time next year, I mean, let's say our rates are double. That person that bought that deal is never going to be able to refinance out of that deal. So that lender
Gotcha.
that has that deal is going to get the property back, and they're going to get the property back for less, it's going to be worth less than what they lent on it.
Understood.
So those deals like that, the lenders, I mean, yeah, you can borrow on those if you have done those in the past and you have a big, long track record of doing those types of deals and a lot of money backing you. But we don't have any options right now for somebody that hasn't completed deals like that. So just, keep that in mind when you're looking at deals, cash flowing deals, in good markets, we can find funding for those types of deals. Sometimes you might want to raise private equity for those. So.
Okay. Thanks, Jerry. Appreciate it.
Yeah, for sure.
Yeah. And Mr. Hawk. He said, with the Fannie and Freddie 65 to 80%. And he said they just saw a 55% LTV in Texas. That's kind of what we've been seeing right now is 55%. And then Sean said, I just don't like empty properties. For empty properties, you have to go to a bridge. That's true. Somebody asked a question. Oh, can you explain the 5 to 50 unit program again? Because I think they missed it.
Yeah.
Please, for the agency.
Yeah, for sure. Freddie and Fannie, it's Freddie. Freddie came out back in February and said that they are going to actively go after multifamily deals that are 5 to 50 units. And the purpose was that they saw just kind of a hole in the market that wasn't being filled, and they wanted to actively go after those unit numbers. They gave all the statistics on how many of them are out there and how many of them need good operators. And to get good operators, there needs to be some good lending products, because good operators are going to look for those types of deals where they can find good lending products. And then it also helps the operator with their exit strategy in the future if there's a good product involved that'll lend on those deals. So they've said that they are going to lean in on deals as their verbiage, or as their verbiage. They're going to lean in on those deals, and they're going to try to lend $2.5 billion. Freddie is, and Fannie's going to lend $2.5 billion this year on properties that are 5 to 50 units. So
Cool. And Foti said when he gets his crystal ball back from the shop, he will let everyone know what's.
yeah.
Oh my gosh.
Yeah, I went back last October. We had just had, I guess, the first few big rate hikes, or no, it was November. I went to Vegas, and it was to a private lenders conference. We're part of the National Association of Commercial Loan Brokers. And so they have their national conference. There's 800 lending brokers, and there was several hundred lenders that were there at the conference. And it was really, kind of everybody just walking around. This was last November, right after the Fed started really hiking the rates, and everything just stopped, and everybody just kind of walking around looking at each other like, what do we do now? Nobody's closed the deal in 3 months, what's going on, and so, we're not able to go this year to it because it's during the same time as our Bring Your Deal workshop with Grant Cardone's Real Estate Club, and said I'd rather go to the Bring Your Deal than the lenders conference. But I think they're having trouble getting attendees to the conference this year because the market's been so dead. Originations on the year are down something like 80% of new loan originations for commercial and residential. And they're saying by the end of the year, more than half of all commercial and residential mortgage brokers are going to drop out of the business and find new work. So, but last year, everybody was just kind of like, it was a real eerie 3 days, just the way everybody, it's almost, you could sense the fear in everybody's faces and everybody's spirits, but it was, everybody was trying to keep a happy face on and act like nothing was wrong, you know? So, but yeah, the markets, I think we're going to come out of it okay. You know, we're still going to be here, and we're going to take the business away from all the people that had to leave the market. So that's the way we're playing it. So it's like the movie Wolf on Wall Street, where he says, I'm not leaving, you know. So that's us right now. But so
just don't go to jail, please.
yeah, yeah, nothing illegal going on here, but we're still not leaving. So what can you do today? You know, we had Sean Thompson earlier, and there's a couple other people on the call here that are able to buy their own deals and KP and do different things. And I'm guessing that most of the people on here on the call want to be able to do that themselves in the future. So what can you do today to be ready to do that in the future? For number one, make sure your credit is in order. You hear all the gurus tell you that you don't need your credit, that when you get big, you don't need, you know, they don't ask you for your credit score and this and that. But when you buy and you're financing through Freddie and Fannie, you need a 660 or better credit score. So work on getting your credit score up. Did you want to tell your credit score story from today?
I can, but I want to give people a chance. Like, if you're on here and you've done big deals and you've done even any deals and you want to speak up and like give some advice on how others can get to where you are, that would be great.
Hey, Jerry, I've got a question.
Yeah.
It kind of goes into this whole thing. Isn't it true that Fannie is credit-based and Freddie is asset-based?
They're both the both. I mean, Fannie and Freddie are both going to look at the asset, and they're both going to look at the credit. So I've never heard that before on Freddie and Fannie myself. But they're both going to look and make sure that your credit's in order. They're both going to look and make sure the asset's in order. So.
Hey, Jerry.
Yeah.
I was going to say, for advice for people who are trying to find something and get something done, if you find a good deal, find somebody who in this group that's had some experience. You know, they can shortcut a lot of things and help you get something done that you wouldn't necessarily get done on your own. We've got some really good people in here. You know, I've seen a lot of you. I haven't worked with some of you, but I've been working with Mike Hawkins and Freddie, and there's some really good people in here, and you can certainly help them figure out the debt portion. So, you know, yeah, if you find a good deal, you know, bring it to the group, and maybe together we can get something done. You know, we're working on stuff now that I couldn't possibly do by myself, and I've found that working with you know, Freddie and Mike Hawkins and some other folks, that we may be able to accomplish something that I never thought might be possible.
Yep. Awesome. Awesome. For sure.
Great.
For sure. I know there's been people on our calls that have done business together. There's been people that met here locally that have been on our calls that we know locally here, and they've done work together and business together because they met each other on this call. So it's good networking opportunity here. So I appreciate that, Sean. Andrea, how are you?
I'm doing well. How are you guys doing? Thank you for
Awesome.
the call. I'm just
Yeah.
going to give you guys a little tip as well that you mentioned, have your credit in order. So whenever I've done a lot of transactions, and I just want to give you guys a tip that whenever you do go under contract, you have a deal that's already operating. Usually what happens with the lender is that they're going to request a balance sheet for the guarantor. And you have to make sure that your balance sheet is in order for any holding entities or operating entities that are associated with the property. So not only you are being underwritten, but also the balance sheet is reviewed usually on a quarterly basis, sometimes annual basis. So just make sure you guys have a really good asset manager and accounting system in place.
Yep. For sure. Yep. That'll be, once you get the deal done, they're going to be coming after you. And I had somebody come to us today for a deal that they're looking at, and the deal was really low occupancy, and it's an assumable loan. And I was questioning, asking, hey, why, are these people in trouble with this low occupancy? I'm asking, trying to get questions answered from my customer, hey, what's going on? Why, are they in trouble? Or is the lender making them find somebody else to take this loan over? What's going on? And they were inquiring, but that can happen if you have occupancy drop really low. You're not making your payments, or they're seeing that you're getting to that point where you might miss a payment or not have the money there. So yeah, they're going to step in when they need to take things over and make sure that it's taken care of. So, and Joel, how are you, sir?
Doing fine. How are you?
Hey, good.
Thanks for taking my question.
Yeah.
I have a chance to buy a portfolio of 4 homes in a college town, and I was planning on trying to rent them out by the room. My question was, would that qualify for a commercial loan as opposed to a residential loan?
Yeah, on a property like that, if you're going to buy it personally, if you have the debt to income ratio, to buy it personally, yeah, you can buy it through your personal name. If you don't have the debt to income ratio to be able to qualify for the loan, you would have to do it based on the asset and the income of the assets. So they call it, the term that they throw out there is a DSCR loan, which kind of encompasses all commercial property loans. So they're going to look at the income of the property, the expenses, and they're going to see, hey, will this property pay for itself plus give you another 20%? And if you can, then you'll be able to get it done. So
Okay.
yeah, so I mean, you reach out to me tomorrow and give me some more information on it. I can get a quote on it for you.
Okay. Will do.
Yeah, for
Thank
sure.
you.
Yeah. So
All right, cool.
yeah, go ahead.
Foti said some of these deals are going to turn into a contact sport, which we have been talking about. There's going to be blood in the streets, and it's hard to show up. Sellers are getting beat up with bridge loans and floating rates with expired rate caps. That's so true right now. That's going on, guys.
And we're seeing them. I mean, we have a couple times a week, we have people coming to us needing to refi. Recently we've had one, they're needing to refi out of a $19 million bridge loan, and the most debt we can get them is $15.5 million. Another one, a hotel, and it's Staybridge Suites. It's a bigger name hotel. They owe $8.5 million on a bridge loan, and the most money we can get them is $6 million. And these deals are happening every day. We're getting calls about these deals, and these people are stuck negative cash flow right now on these deals because their payments are so high. And they can only, you can only be negative cash flow until your savings account runs out or you throw in the towel. So if things don't change around to where rates come down, or you think, well, they're negative cash flow so much that their property can only refi, they're $4 million less than what they can refi for or whatever. I mean, you can't raise rents fast enough to make up $4 million bucks. Especially in this market. I mean, 2020, 2021, people were raising rents fast enough to do that. Right now you can't do that. And there's these deals are all over the place right now. And you just, and these owners are hoping and praying that they're going to be able to refi with the rates start coming down, but we're not guaranteed rates coming down. So be patient if you're shopping for deals, and the deals are coming to the market. So but work on your, yeah.
I heard I was talking to a broker today, and this is going to blow your mind. He has a customer or a seller that's got 11,500 units, and they're all on bridge.
Wow.
And they are dumping everything they can as fast as they can.
Wow.
11,000. That's like Grant, like being Grant and having every one of his properties on bridge debt. Could you imagine?
Wow. That's crazy. So I've been saying that we're going to start seeing news stories, because when you see, I just mentioned a property 19 million owed on bridge debt. These people probably have another 6 million, 5 or 6 million in equity that was invested into this deal, of LP partners that have invested into the deals. That hotel probably has $3 or $4 or $5 million in LP money, people's money that have been put into the deals. And that property, neither one of those properties is worth what they paid for them, right? That's for one. And so that equity that was there, I mean, if somebody that put a 100,000 or $1 million, you get a figure their value now, instead of 100,000, is probably worth 40,000 of their equity portion, and that $1 million is worth, 200,000 to 400,000. When these things default, if they default and they can't sell them off or they can't refinance them, the equity portion on these deals is gone. I mean, that money, the lender doesn't take a property back and pay back the LPs. They take the property and they count and get their money back, and that's all that matters to them. So I'm telling you this because a lot of people on this call are going to be raising money for deals. And as news stories start coming and hitting the market, it's going to be mainstream news stories of grandmas and grandpas and single moms that invested 100,000 in this deal or 100,000 in that deal, and they lost their life savings in a real estate deal. And I've already seen it. I've been telling my wife that. I've been telling Shelly that we're going to start seeing across, the headlines on Fox and CNN and all the different, whatever you call propaganda channels is why I think of them as. But you're going to start seeing, grandma lost her life savings in this real estate deal, in a speculative real estate deal. And I saw my first news story similar to that just yesterday. And the real estate story is about Grant Cardone. And so everybody on here, I mean, knows Grant, knows his business. We understand the business, and we know he's not a con artist, right? I mean, we just spent another 20,000 to be in his real estate club for the second year. So we don't think of him as a con artist, but Yahoo News here is portraying him that way in this news story. And it's called "The Real Estate Hustle Culture Con That's Exploiting Investors and Wrecking the Housing Market." That was the news story that Yahoo News had out there. And so when your potential lending partners or your LPs are reading news stories like this, it's going to be harder. It's going to be a harder sell to find your equity for deals. So I'm just giving you guys kind of where the market's heading, and when it gets harder to find equity for deals, and then we have all of these deals hitting the market, the values are going to go way down, and then the big money is going to step in and start scooping up deals. And, and if, we can all position ourselves in better financial positions, then we're going to be able to get some deals too. So just letting you guys know, it's not all doom and gloom, but looking at how the market goes and how the cycle's going, it can kind of help you, as you're planning for the future. So, but those, those news stories are coming. I've been saying they're going to come. And then I saw my first one here this week, and it just happened to be about Grant. And, they even were trying to really smear him so bad as to say, that his big business event that he has in Vegas every year had Donald Trump as a guest, is what they were saying. And, trying to make him, I guess, paint him an even a worse picture by, putting him in a box with Donald Trump, I guess. I don't know, but it was a pretty one-sided article, and they're going to be doing more and more of that. So needed for a quote. If you need a quote from us, profit and loss statements or T12s, rent roll, an OM if you have it, or in a summary of what you plan to do with the property. When you start getting close to, getting an LOI accepted, we're starting to get serious about getting you some hard numbers, SREO, PFS, and that'll come from your KP, or if you're in that position now, that'll come from you as well. So, and you already know that if you're in that position. So, our next Zoom topic, we'll be talking about DSCR. That'll be September 13th, same time. And there's our contact info one more time, and we're over about 15 minutes. So appreciate everybody being here. Hope you guys got some new info out of it, and have a great rest of the week.
Yeah, thank you guys. There was a lot going on in the comments. I don't think I can read all of them, but it was good. Thank you guys for joining. JJ just shared the link for the community, the multifamily. I don't know why I have. He just shared the link. Join them yet? When them, you will get all the dates, all the for each event, so you don't have to worry about searching for them.
And you're cutting out quite a bit. You're cutting out.
Okay.
So
sorry.
I see Cheryl has her hand raised. Go ahead, Cheryl, real quick.
Oh yeah, thank you. Hi Jerry.
Hey.
Hey Shelly. Thank you. I just had a quick question. If someone signs up or if they invest in a deal through the referral, how do you know who referred them?
So with our referral program, we just ask for a introduction from you with that person. And it's either, we map it out on our referral program Zoom. We give examples of how people have done it for us in the past. So it's pretty simple. Just either an email or a text message saying, "Hey, Jerry, this is my friend, Shelly. She's an investor and she's looking to get debt on a property. I would love you guys to connect and see if you can help them." And
okay.
And then we'll take it from there.
All right, and it's email and position title, right? And then in their company.
Well, no, just email us and hook us up with their contact info, and then we'll reach out to them, or they can reach out to us. So
okay.
Make it a joint.
What, Shelly?
I think, did you email me last week or the week before? And I think yeah. And the information I would need is from you. And then this is how you get paid. So that's why I need the information from you.
Yeah.
Oh yeah. Find me and
you need
a lot of typing for all this arthritis. Can we just call you and say, hey, here's my friend, call him.
Yeah, that'll work too. Yeah.
That's what you do.
Yep. That'll work as well. So yeah, just connect us with them, and and then we'll ask for, if we can get a deal closed with them. Shelly will be getting with you about W-9 and that kind of thing, because we'll be paying you.
That was what the email was about, was the W-9 and stuff. I thought she was asking about that.
Oh, okay.
So give us a call, give us a text, an introduction, email, text, or call would be great. And we'll
Okay.
take care of.
Yeah,
How about a
folks,
click funnel for
Yeah, you
our website or something?
yeah, you can always call us with that, but it's best to do an email or a text just so we have record of it, so we don't forget. Or if we do forget, you can say, "Hey, my buddy got a loan from you, and I connected you. Here's the email." So Shelly does. Yeah, Shelly does a really good job of organization. If it was me, I would never know, but she keeps everything organized really well. So, but don't forget to jump on the
That's
call.
what's good about a duo, right?
Yeah, that's right.
Yeah.
Go Shelly. And you got my info, right, Shelly?
I'll have to go back and check and see what I got. I can't remember.
Okay. Yep, I responded.
Okay.
Okay.
Thank you very much.
Yeah, thank you. And so this is the list of calls for the week. And thanks everybody for being here. And
Thank you.
have a great
Thank
rest
you,
of the
guys.
week.
You too. See
Holiday
you
week.
next week. See you in the group.